Joining us now to talk about what he sees ahead for the stock market, Phil Blancato is back with us. He's CEO of Landenburg Thalmann Asset Management. Phil, good to see you again. Thanks for joining us tonight.
Thank you for having me on.
So here we are again, near all-time highs with the stock market, and yet certain sectors of the economy are slowing down. What do you make of this dichotomy here?
You know, I think this is a really unusual event. You think about it, we've had really no earnings growth at all this year. Probably going to have negative earnings growth at the end of the second quarter, for the second quarter. And yet the stock market's up over 20%. So what that tells me is there's real weakness in the underpinnings of the U.S. economy. Not in the consumer, that's what's holding it up. Doesn't mean recession. But as far as the ability to grow company earnings, it's weakened out. And for that reason, I have real concerns about the stock market.
And so, Phil, even you just said, unusual when describing this economy. So then how do you advise your investors in this type of market?
Move to neutral. We have made a lot of money this year and over this amazing bull market, nearly doubling. If you've made those kind of returns, and they're not normal to make this kind of return on a regular, consistent basis, take some profits. Move back from an overweight equity position to a neutral position, and then let's see what happens with the Fed, with China, with the earnings cycle, with the consumer, with employment, all these things that matter to the improvement of the economy. But for now, take some money off the table because there are signs that we're slowing down. You just named a few.
We've certainly heard from plenty of companies who attribute some of their uncertainties to the trade issues. But how much will the Fed help if, in fact, we get a Fed rate cut later this month?
Well, the Fed's mandate's a little bit confusing right now because on one hand, we have full employment. So that mission has been solved. On the other side, they want to make sure inflation is stable, not run away, and we certainly don't have runaway inflation. Their concern is that we have not enough inflation. For that reason, there's a chance they cut. I actually don't think they will. I think they're going to pass one more month. However, the Fed could come in and stimulate by creating a stronger borrowing cycle. What the market needs is a catalyst. If interest rates go down, maybe the consumer then really does start to buy homes and lever up and buy more goods. Corporations issue more debt and start to grow their bottom line rather than maintain it. So the Fed could throw a lifeline by lower interest rates. I'm just not convinced it's enough to drive the market higher in the short term.
And Phil, you've already outlined some concerns for the market. Anything that you think, at least in the short term, other than the Fed cutting interest rates, that might further stimulate the market?
That's a great question. Today there was a number, well actually this week was a number about retail sales. You see, the one thing we always forget is that 70% of our economy is driven by us, the consumer. And the consumer's got a high savings rate right now. If the consumer starts to spend and starts to borrow, which we saw a little bit of that this week, that's a game changer. Then suddenly we have a catalyst to drive things higher. Couple that with the Fed getting maybe a little bit easier and the potential of a tariff deal. That's a big one. If there is some negotiation that prolongs, it's going to take some time. Those three things coupled together would drive the market higher. Not one of them by themselves, I don't think. But if we get relief by all three, then we will go higher. I'm just not expecting it as of right now.
Phil Blancato with Landenburg Thalmann Asset Management. Good to see you again, Phil. Thanks.
Thank you.